Wherever the United States takes the lead, the world will follow. This has been the case in the bond market over the past month as U.S. revenue has steadily surged. However, it is unlikely that Europe will follow the lead of the world any further if U.S. Treasury bonds continue to move upwards towards a higher revenue range. This is simply because there is not enough high-quality European debt to help keep rising. On the other hand, it is easy to identify the reasons behind the increase in U.S. government bond yields in the following points. First, the presence of a Federal Reserve Bank bent on raising interest rates and reducing quantitative easing measures at a faster pace. Second, the occurrence of an active economic growth. Third, the widening deficit in the federal budget. This means that the Treasury needs to sell more bonds. Fourth, the continuous rise in the inflation rate, by about 3%. Fifthly, the risk that China, the largest holder of U.S. Treasury bonds, will decide to use them as a weapon in the worsening trade war between the two sides. Of course, all five of these factors are causing bondholders to panic. It is worth noting that the Fed is reducing quantitative easing by $50 billion a month, while the European Central Bank intends to add more during the current year of 2018. As for Europe, we find the exact opposite. First, the deposit rate of at least 40 negative basis points will be maintained for another year. Second, the quantitative easing measures taken by the European Central Bank will continue until the end of the year, albeit in a muted manner. Third, growth in Europe is half that of the United States. Fourth, the net issuance by the German government over the next few years will be about zero, according to analysts of the UniCredit Foundation. Fifth, the inflation rate within the euro's pivotal region remains stuck at only 1%. These factors do not paint an encouraging picture of buying European bonds, but they do suggest that revenues are unlikely to move in either direction. Another dynamic constraining German revenues is scarcity. Demand for super-safe debt only rose as the availability of core European sovereign bonds shrank thanks to the massive quantitative easing program run by the European Central Bank. For its part, the European Central Bank controls more than a quarter of the premium issue, as is the case with other sovereign bonds in the Eurozone, at a time when it has no plans to convert it into liquidity. Foreign central banks and sovereign wealth funds account for nearly 37%, according to UniCredit. These are long-term carriers, so there is not much room for free floating. The gap between U.S. and German revenue appears to be widening further. It is worth noting that the gap between German and American bonds has widened steadily from the level it was in after the financial crisis for more than 250 basis points now, and it seems that this gap is on its way to widening further as the United States and Europe move in two different directions.